Hello students, in our previous video we discussed the taxes, the different types of taxes, introduction to GST, and continuing the series we are discussing here in this video the input tax related discussion. Let us begin with an example that you are running a cafe, your dream coffee shop. When you buy coffee beans, milk, sugar, in fact, even furniture for your cafe, you pay GST, right, to your suppliers. When the supplier supplying you these products, he will charge GST. It means you have to pay, right? So this is input GST for you. The GST you pay when you purchase goods or services for your business. But here is the magic. Input GST isn't just an expense when you forget about it. It's like tax credit card that you can use it later. Think of this way. When you pay input GST, you are essentially telling the government, hey, I've already contributed to the tax pool. Remember this when I need to pay my final GST bill on my sales. Making point? So input GST here is an asset. It is the money you can recover from the government later. That's why we debit input GST accounts, because it's something valuable that belongs to us. Now let's get our hands dirty with journal entries. Remember, input GST has its own VIP treatment in accounting. Suppose, as I mentioned in the example cafe shop, you buy coffee beans worth 10,000 rupees. The supplier charges 18% GST. Let's break this down. So 10,000 rupees base price and GST 18%, that is 1,800, and total payment to be made to the supplier is 11,800, isn't it? So here is the journal entry. So in our earlier journal entry discussions, ignoring this GST, we would have passed a journal entry called purchases account debited to supplier account, isn't it? But whereas in the case of GST involvement, we have to pass this journal entry called purchases account debit 10,000, input GST account debit 1,800 to supplier account 11,800. Notice these crucial things here. Purchase account gets only the actual cost of goods 10,000 rupees and not the 1,800, isn't it? The 1,800 we have to split it into input GST. It gets its own separate account 1,800, and both are debited because purchase is an asset, expenditure, whereas input GST is an asset. So purchase is an expense, increasing debit, whereas input GST is an asset, increasing, you have to debit. So you might wonder why not just debit purchase account with 11,800. Great question. But because of input GST credit mechanism, it is recoverable from the government. If we club it with purchases, we lose track of money we can claim back, right? So it is like mixing your personal money with the money you lent to your friend. So you need to track what is coming back. So government gives back in the form of input tax credit the taxes paid by businessmen on their purchases. Hence, it is not cost to the businessman, it is an asset which is recoverable from the government. Obviously with terms and conditions that you have to follow, whatever the government puts conditions. Let's explore another scenario of that particular cafe shop. If you have purchased fixed assets, so that cafe shop, as you are running, you buy a coffee machine worth 50,000 rupees plus 18% GST. So what would be the journal entry? The coffee machine debit, because asset is coming into the business, asset is increasing, debit, and that 9,000 part GST, input GST, you have to debit 9,000. And to credit, the credit has to be given to the supplier or the bank account. So if it is paid, bank. If it is not paid, you have to credit the supplier account, 59,000. So coffee machine debit 50,000, input GST account debit 9,000, to bank account 59,000, or to supplier account 59,000. Same principle, the machine's actual cost is 50,000 rupees and the 9,000 rupees GST is our recoverable credit. Let us take another scenario wherein you purchase services. Like for example, you take a cleaning services or housekeeping services for 5,000 rupees plus 18% GST. Now, cleaning expense is an expense you have to debit when it is increasing. So, cleaning expense debit 5,000 rupees, input GST debit 900 rupees to cash account if it is paid, or if it is not paid to service provider account. So, cleaning expense debit 5,000, input GST account debit 900 rupees to cash or supplier account 5,900 rupees. Whether it is goods or services, input GST treatment remains the same. Please remember this. You have to separate it and debit it. There is another twist here. Suppose what happens if you return back the coffee beans to your supplier? So cafe shop is returning the goods for 2,000 rupees plus GST, obviously. So now supplier account has to be debited 2,360 rupees here, to purchase returns account 2,000 rupees, to input GST account 360 rupees. Students, please remember that when you have purchased goods and you have availed the input tax credit by debiting it, and when you are returning back those goods, then you have to reverse the input tax credit, isn't it? So earlier you debited, now you have to credit because you are not using it for the purpose of business now, because you are returning it back to a supplier. So when we return goods, we also return the input GST credit we claimed earlier. So it is like returning the borrowed book. You get your deposit back, but you lose the privilege, isn't it? Next, moving on to the little bit advanced concepts. Input tax rate utilization. Here is where input GST becomes your best friend. Now, assuming in that cafe shop, that input GST total debited, what you have considered as an asset, 15,000 rupees, let us assume. And on your final bill also you have to pay GST, right? We call it as output GST. That is 20,000. So input GST which you have debited is 15,000, whereas output GST you are supposed to pay is 20,000 on your sales. So the journal entry will be output GST account debit, because that was showing liability credit balance. Now to reverse it, you have to debit it. And input GST being asset, now you are using it for the purpose of making payment of GST, you have to credit. So output GST account debit 20,000 to input GST account 15,000. Since the payment is more than what you have input GST, the balance has to be paid in cash or bank account. So to make payment, first we have to create an accrual entry called GST payable account. So subsequently it gets paid off like GST payable debited to cash or bank account. So in this case, the journal entry is output GST account debit 20,000. This is basically a liability we have to offset through input GST and the payable entry. Now, in this case, the cafe shop is only paying 5,000 rupees to the government instead of 20,000, isn't it? So that's a saving of 15,000 rupees. This is how we call it as the input tax credit set-off mechanism. So instead of paying 20,000, he is paying only 5,000, because that input tax credit, what he had paid to already to the supplier, that now utilized while making payment to the government. There is another concept called blocked credits, where not all input GST is recoverable from the government. Please remember this. There are some blocked credits, like that friend who never pays you back. So the examples of blocked credit are the motor vehicles if it is used for personal use, if you purchase food and beverages, or if there is a membership club expenses if you have incurred. All these are blocked credits. And similar to these, in the CA Foundation syllabus, there are certain examples which they have given, because at a foundation level it is only dealt on a overview basis. They have not dealt in depth as to the section 16 of GST Act. So you should remember the situations wherein you cannot take input tax credit, or situations wherein you have to reverse the input tax credit. Like for example, the one which we just discussed now, the purchase returns. Purchase returns case, you have to reverse the input tax rate. Similar to that, when you withdraw goods for personal purpose, so again you have to reverse the input tax credit. And when the goods are given on a free of cost basis or a sample basis, again you have to reverse the input tax. Remember, input GST isn't just a tax. It's your business secret weapon for managing cash flows. Master these journal entries and you will breeze through your CA Foundation exams. In our upcoming video, we will be discussing on the output GST and the journal entries relating to the